Okay, so I want to dive into pension funds. And remember for the exam, this is no excuses. You have to be prepared for this for the exam. I'm almost 100% sure if I were to bet money on this, you're going to see a question about pension funds on the exam, so expect it. You're going to see it when you review a number of the exams. So it's no surprise, it's most likely coming. I say it's likely coming, and I want you to focus on defined benefit plans, not defined contribution plans. Typically the questions are defined benefit. We'll talk about this as we go through and explain more, but there's really not that much to do defined contributions. It'd be a kind of a boring question. Okay, so pension funds, what are they designed to do? Well, they're designed to save and invest money to give income for plan beneficiaries when they retire. Okay, so there are two major types of pension plans that are covered in the CFA material. We've got defined benefit, and again, I want you to key on defined benefit plans. These are complex. There's a lot of things going on that we need to understand, and they're great for question writers. Defined contribution is the second. There's very little to test you on defined contribution. So I want you to focus on defined benefit plans. And the first thing that I want you to think about when you deal with a defined benefit plan, I want you to immediately figure out if it's fully funded. Because if it's fully funded, we already know how that's going to impact the ability to bear risk. If it's underfunded, here's the reality. Most of these defined benefit plans out there, unfortunately, are underfunded. So at best, they're going to have average ability to bear risk. If it's underfunded, it's probably going to be below average ability to bear risk. So even though they need more returns, they're not able to get them because they don't have the ability to handle market volatility. Okay, so again, I want you to focus on defined benefit. We're going to cover defined contribution slides in our Kaplan material. They're great. There's some good points to know, but it's not heavily tested. I want you to focus on defined benefit plans. Okay, so you guys know this as well as I do. Over recent years, firms are moving away from defined benefit plans to defined contribution. And really, I think there's two reasons that we identify here that's causing this. Number one, there's a lot of risk to the employer if they have a defined benefit plan. They have to make sure that they can pay that liability. Now, the other thing, the days of one person working for a company for their whole career unfortunately seem to have ended. My dad worked for the military his whole career, and my grandfather worked for the same company his whole career. Many of my family members have worked for the same company their whole career. Unfortunately, for most of us, I was with an investment firm that got bought and sold every year for 3 years in a row. So sometimes you end up having to change companies, not even because you want to, just because your firm gets acquired or sold. So again, the second reason we're moving from defined benefit to defined contribution, employees wanted portability. Well, what happens if I don't retire at that firm? Then I lose all my retirement benefits that I've earned. Okay, so that's what's so nice about the defined contribution. You can bring that with you to your next firm. But again, that helps understand what's going on in the practitioner world, but I want to bring your attention back to defined benefit plans. That's really the focus of what you need to understand, and that's where I'd put my money on if I'm trying to prepare for the exam. So we've got a nice little chart here. I think this is fantastic. Get in the habit of starting to put together note cards. I think this would be a fantastic note card, a couple note cards. So let's look at the features. And we've got defined benefit plan for defined contribution. So what happens here? Well, the benefit payments, they're going to depend on final salary. The defined benefit plan is going to have a number of rules, how long you have to work, and they're going to have some methodology that they use to calculate that benefit. Well, this is the interesting thing. It creates a measurable liability for the plan sponsor. Who's the plan sponsor? The employer. Okay, then we look at contributions. it's primarily the employer, but hey, maybe the employee contributes a little bit too. But in contrast to that, in a defined contribution, well, what are the payments? It really depends on the performance. What funds did that employee choose? And here's why this is unlikely to be tested on the exam. Once the corporation or firm makes those promised contributions, there's no liability for the plan sponsor. So the liability ends. Okay, and the contributions, hey, these are primarily employee, but there might be some matches from the employer. Okay, moving on, who makes the decisions? In a pension fund, it's going to be a sponsor, so the employer and their investment staff. This is the key. Who holds the investment risk? If the firm doesn't do this right, they're going to be on the hook for a lot of money. So the risk lies with the fund sponsor. Now, in contrast to defined contribution, the risk is faced by the beneficiary. So guess what? If you didn't save enough money for retirement, well, you're out of luck. The firm's off the hook. So what the sponsor is going to provide a suite of available choices for you to choose, but then you have to make those decisions. And unfortunately, this idea of longevity risk, if you don't plan properly for retirement, there's a good chance that you're going to run out of money. And sadly, what we see in the real world, people are not saving enough money to retire. It's just that simple, and it's fairly bleak. And we're seeing it even worse in the millennial and the younger generations. Okay, so mortality longevity risk that I talked about. In a defined contribution, who faces that risk? The employee faces that risk. Now, in a defined benefit plan, well, what's happening here? Well, the employer is going to be on the hook. And what happens, some employees die sooner than others, some live longer. So this is all pooled money. So if the beneficiaries live longer than expected, the people that die earlier fund that. So that extra surplus. And the risk, again, is faced by the sponsor. So again, I think it's really important to understand who holds the real risk. So the risk is held by the sponsor, not the employee in a defined benefit plan. In a defined contribution, the employer's off the hook. Hey, we paid our matching contribution. Now it's you. And if you don't have enough money to retire, well, that's too bad. You might have to get a part-time job. Okay, so it's really, really important to understand that. Okay, so then there are some hybrid plans out there. Do I need to go out and memorize all these things? No. Just know that there's some combinations. If a question like this comes up, they're going to talk to you about how it works and the hybrid. So I'm not too worried about this. Again, I want you to emphasize on the defined benefit plan. So who are the stakeholders? Well, the biggest one is the plan sponsor, which is also the employer. They must make contributions, and poor investment performance is going to result in the sponsor having to make extra payments. This is an unfunded liability. Unfortunately, there are rules about how they have to report this on their financial statement. This is a legal liability that the employer is on the hook for. Okay, who are the beneficiaries? Well, these are the employees, the retirees. Now, ultimately, they face the risk if this employer goes bankrupt or goes out of business or can't pay, or somehow the employer defaults. So, I think the key stakeholders to me understand the employer bears the risk, but the employees really have the ultimate risk, because if this employer defaults, then how do they pay their bills? Okay, there's also the investment staff as a stakeholder, the investment committee, the board. And this is an interesting thought. And I really like what the CFA Institute did with this. So who else is a stakeholder? A government is a stakeholder. I've never thought about it before this way until I read the material, but guess what? Taxpayers are ultimately going to have to face the cost of providing welfare for those who failed to adequately save for retirement. So the government is actually a key stakeholder as well. Now, they're going to give tax incentives for the employer and the employee, ways you can save for retirement. But ultimately, if things don't work out, the government's going to be on the hook and the taxpayers are going to have to provide some welfare, whatever that is. Now, it's not clear how all of this will work. This is probably going to be decided by elections coming up over the next few years. But ultimately, taxpayers are on the hook, so the government is a key stakeholder. Okay, how about some other stakeholders? How about the shareholders in that corporation? If this is an underfunded plan and I've got to report this on my balance sheet, well, I just made my financial statements more risky. So right off the bat, my cost of capital is higher for the firm, and there's a higher percentage that this firm might have to pay higher interest rates, higher costs, and it may ultimately result in the demise of the firm because of this underfunded plan. Okay, and it's, again, as I mentioned, it's going to lead to higher financial risk, and it's going to impact share price volatility. And I want to speak for a second. Share price volatility isn't something that really worries most investors when the stock price goes up. Hey, I don't care how volatile it is on the upside, but if the stock goes down, that's when I care. So we start getting into these ideas of behavioral finance of loss aversion. So again, when we're looking, let's just say at standard deviation, it's looking at both returns up and down. You know, in reality, employers don't care that the stock went up 70%, but if it went down 70%, they really care. Okay, so let's talk about liabilities and investment horizon. So the liabilities of the defined benefit plan, basically they're the present value of the benefits. Okay, so this is a liability. It's that present value of the benefits. Now, do you have to calculate this? No, luckily there are actuaries that do most of these calculations. But you are going to be responsible for understanding how certain workforce characteristics and plan characteristics impact. Again, I want you to focus on this ability to bear risk, and I want you to focus on time horizon, and I want you to focus on liquidity. So think about, if all of a sudden workers are older, what does that mean? Well, it means the time horizon is shorter when they start drawing money down. We're going to need more liquidity. So that lowers ability to bear risk. So I want you to think about ability to bear risk, and I want you to think about the present value of these benefits are the liability. Okay? So what typically happens, the corporation or firm is going to have rules about when can you get this money. So you need to understand when are they vested. So there's going to be a minimum number of years. Okay, so let's talk about funded status. Remember I told you what I'm most concerned about when you look at defined benefit plans. I want you to find out the funded status. That's going to determine the ability to bear risk, or at least a big part of it. Okay, so this can be measured using the funded ratio. What is the funded ratio? Just take the present value of the assets minus the present value of the liabilities. Hey, the more assets we have, the higher this is going to be and the better. If this number is very low, that means that we've got a big problem here and this fund is very underfunded. Okay, so again, funded ratio is a good way to look at, but I'm ultimately looking, I want to know the funded status. Are they fully funded? Are they overfunded? Are they underfunded? Because again, that's going to tie into this ability to bear risk. Okay, some other things that we need to know. Some liability factors. What are some characteristics that change? So service tenure years. If you work more years, you get more benefits. You make more salary, you get more benefits. And this longevity, it increases liability. So basically, if this retiree lives a lot longer, or should say on average the retirees live a lot longer than they expected, they need to come up with more benefit payments. So the cost of this plan gets even more expensive. Okay, employee turnover. Hey, guess what? If an employee leaves, that lowers the liability. So that's great, at least for the firm, and hopefully it'll be good for the employee as well. But remember, defined benefit plans are not portable, where defined contributions are. And then any type of additional or matching contributions, this increases the liability. So again, more benefits you promise to employees, the more the employer is on the hook for those. So what are some important factors? Well, we need to understand the expected investment return. Well, if we have some liability here and we can get some increased expected return, well, what does that mean? It means that this discount rate actually goes up, which means the liability actually goes down. Okay, so that's the thought process that I want you to think about. So this discount rate, it can lower the liability. So a higher discount rate gives a lower present value of benefits. But the discount rate can also go against you as well. So understand expected investment return and how it impacts the discount rate. Now, let's get into planned beneficiaries. Well, it breaks down to active lives and retired lives. If you're active life, you're still employed and you're earning benefits. If you're retired lives, you're retired, you're receiving benefits. This is a cost. This is an outflow to the defined benefit plan. Active lives are an inflow because ultimately they're still employed, they're earning benefits, but we don't have to make any payments there. But we do have to make payments here. Okay, and again, the higher proportion of retired lives to the plan, what does it do? Remember, I want you to think about ability to bear risk, and I want you to focus on that time horizon, and I want you to focus on liquidity. If the time horizon shortens and or liquidity needs go up, that ability to bear risk goes down for the plan. Okay, and other thing, keep your eye on plans that are frozen. What does that mean? Well, it means they're not taking any more benefits. So what does that mean? It means the time horizon just went down. So guess what? Time horizon goes down, ability to bear risk also goes down. Okay, so do you see how all these things are connected? You know, we can't prepare you for everything, but at least you can kind of see the big picture. And if you can understand the big picture going into the exam, you have a higher chance of looking for the facts that you need in order to support what you think is happening. So again, I told you focus on this funded status. Hey, guess what? If they have a higher funded status, it means their ability to bear risk goes up because they can withstand market volatility and short-term losses. Another thing, I want to look at the sponsor's financial strength. If this firm is extremely strong, well, they have ability to bear risk that goes up. If this plan doesn't work out, the sponsor can add more money. Also, the size of the plan. If the size of the plan is small, that increases the ability to bear risk because, again, the firm has plenty of money that they can use to support this plan if they have to. If the size of the plan gets too high relative to the operating profits, then we've got a problem. Okay, so let's look at some risks. It wouldn't be a finance class if we didn't talk about risk as well as benefits. So what are some common risk exposures? Well, one of the things that I want to be comfortable with, I want to know the correlation of the operating result to the assets. Because what can happen if they're linked, the firm might have trouble making payments during bad times. So I'd like to see very low correlations. Okay, another thing that I'd like to think about is I want to see these provisions for retirement or lump sum. Why? Because that's liquidity. You're lowering that time horizon. You're decreasing that ability to bear risk. And then I want to see workforce characteristics. Hey, the younger the workforce, the more time you have. The more time you increase ability to bear risk. Okay, so again, these common risk exposures, I want you to really think about if you can get low correlation of the sponsor's operating results and the returns on the pension assets, the sponsor's likely to be able to add money during periods of plan assets. But if the correlation is high, they're both getting hurt, the plan and the sponsor's finances at the same time. Okay, so let's look at two factors that increase. Again, when you're looking at these questions, take a breath, slow down, make sure you don't see decrease there when the word is increase. So the plan has 0 retired lives. How does this impact? Again, I want you to think about time horizon. The plan has a long time to invest that money because they're not paying out any benefits right now. And let's look at if a plan doesn't offer any early retirement or lump sum distributions. So the liquidity needs are low. So again, that increases your ability to bear risk. So do you see how all these come back to how do these impact the ability to bear risk? That's what I want you to be thinking about with the defined benefit plan, because ultimately at some point you're going to be building a portfolio for this defined benefit plan, and you need to know what plans are acceptable, which assets are acceptable. Well, that's going to be determined by that ability to bear risk. So what are some factors now that decrease the plan's ability to bear risk? Well, if a firm has high debt levels than the industry average, that's going to lower the ability of the plan to make contributions. So if the plan assets decline, hey, you don't have the extra money to put in here. That's going to lower your ability to bear risk. And then again, this is the granddaddy. This is where I want you to focus. If a plan is underfunded, the ability to bear risk goes down. So, and you really think about it, the CEO and the executive team, they would love for you to be able to be more aggressive on your portfolio construction and help them out earn some extra return. But the problem is your duty is to the beneficiaries. If you're underfunded, you can't handle market volatility. So it really restricts the choices. And when the defined benefit plan really needs to increase return potential, it can't. Okay, so that's why I want you to zero in on the funding status. It really drives this ability to bear risk. Okay, so let's look at some liquidity needs. Really simple. This defined benefit plan has to have enough liquidity to pay the benefits as they come due. And when are liquidity needs generally higher? Hey, retired lives are higher. People are retiring. We have to start paying out benefits. The workforce is older. Why? Time horizon is shorter. We're going to have to start paying out benefits. So again, time horizon and liquidity are key areas to think about. Okay, so when are liquidity needs generally higher? Again, the plan has a high funded status. Now this might be a little counterintuitive, but it's an interesting thought. So the plan has a higher funded status, so they're likely putting lower contributions and there's more benefit payments. And the other thing I want you to think about, if the plan participants have the ability to switch or withdraw from the plan, that's going to trigger payments to participants. So again, always think about time horizon and liquidity, and it will help you out immensely as you're going through this. And again, defined benefit plans, no excuses. I need you to be comfortable with pension plan, defined benefit plans in the pension plan. Now, the other thing that I want you to think about are some external constraints, because there are a lot of rules and regulations on pension plans, especially defined benefit plans, but they vary. Do you need to know all the plans and all the rules in every country? Of course not. But there's extensive reporting on fees and cost. There could be personal liability for pension trustees. There are tax rules. There's a lot of things going on here. So you're going to have to read the facts in the question. And again, if it's too complicated, you need to seek help. Get qualified assistance. Okay, defined benefit plans, external constraints, their accounting rules again, they differ by country. So U.S. defined benefit plans, they must follow GAAP. Remember GAAP, generally accepted accounting principles. So what are the rules of GAAP? You've got to the funded status must be shown on the balance sheet. And the public pension plans must follow the General Accounting Standards Board rules. So what does that mean? That means plan assets are reported at market value And then liabilities are going to be reported using some form of a blended approach. How to calculate all this, that's above the CFA exam level. But understand that these things are items and facts that you're going to look for are going to help you answer this question successfully. Okay, and I just want to stop for a second and remind you that the focus of this exam is on the portfolio management side, not forensic regulations, taxes, and accounting. You could spend the next 6 months preparing for the exam, learning all these regulations, rules, and taxes, but it's not going to help you on the exam. They'll give you what you need to know. So just understand the basics that we have in the slides here. I think you're fine. Okay, so what are some investment objectives of this pension plan? The primary objective is to achieve this target return over a long-term horizon, consistent with funding the liabilities. So let's put that in English. The actuaries calculate some target return. That's what you're trying to get. And at the same time, you need to be able to pay these liabilities that you have. Okay, a secondary objective could be, hey, I tell you what, can you minimize the contributions that we have to pay to this plan? Well, that's a secondary objective, sure, but only to the ability to bear risk and the only suitability of the fund. I can't put you in extremely risky investments if your ability to bear risk is below average. Okay, so now we're going to move on to defined contribution plans. And again, this is not heavily emphasized on the exams previously. I think it's important you understand defined contribution plans. They're certainly happening in the real world. This is what most of the plans are being replaced to. Defined benefit plans are phasing out. But I think the Kaplan slides do a great job on defined contribution plans. And I think going through the Kaplan reading and the Kaplan slides, I think that's a good overview of defined contribution. I'd much rather you spend your time and energy on defined benefit plans, digging through the CFA material, digging through problems, practicing. There's just not a lot to talk about with defined contribution plans. So who are the stakeholders? Well, the plan sponsors, the employers, they don't have the investment risk or the longevity risk, but they still have to contribute whatever their matching is to the plan, and they're going to have to oversee the plan and make sure there's suitable investment options. So it's not that they do nothing. They do a little bit, but nothing as much as defined benefit plan. And again, I want you to realize who bears the risk? The employees. If you don't have enough money to meet your retirement goals, well, then that's on you. That is not a liability of the firm. Okay, who are some other stakeholders? Well, the board. The board has to select the default investment options, and they have to figure out ways to get participants to engage. Again, this is an interesting thought. Who else is a stakeholder? Ultimately, when all these people keep retiring without enough money to retire, taxpayers are ultimately going to have to pay the cost of providing this welfare. Now, again, are they going to cover the full cost? Unlikely, but they're probably going to pay something. And as the generations get older and older, funding these taxpayer costs, Social Security, are getting harder and harder. You know, I personally don't even think about it when I plan my retirement. Okay, what are some liabilities? The liabilities of a defined contribution plan are the required contribution to plan assets. And again, there's no liability associated with future benefits. So what does that mean? Nothing goes on the balance sheet. Once they make that payment or contribution, whatever it is they have agreed to, they're done. Okay, individuals, ultimately, when we're looking at the investment horizon, we need to look at the individuals. So it's going to be linked to their age. If you're older, well, you have a shorter time horizon. So you need to adjust your portfolio. I love this. Many firms today and defined contribution plans, they're building life cycle funds. So you're going to retire in 2020 or 2030, 2040, and then it will automatically adjust the portfolio more to fixed income and less out of equities as you get older, so you don't have to do anything as an investor. I love that plan. So what are some liquidity needs? Well, remember we talked about the primary drivers of liquidity: the age of the workforce, the ability of participants to switch or withdraw from the plan, and then some external constraints. Regulations vary by country, but ultimately you're going to have to do some type of education for the plan participants to save from retirement. And we've talked about in a lot of countries, in the US especially, if you withdraw money from this defined contribution before you're 59 and a half, you're going to get penalized. You're, again, not a CPA. They'll give you this information if you need to know it, but just know that there are unfortunate tax disadvantages oftentimes if you take money out of this defined contribution plan. So what are the objective? Hey, fund me in retirement. That's the objective. Okay? So basically what this means is the sponsor wants to provide cost-efficient default options for disengaged participants. So let's talk about this for a second. I did consulting at one point, and I started to look at corporations' 401ks, defined contribution plans. What I found is too many employees had assets in cash, they had it in their employee plans, or they built a portfolio 20 years ago, and then they never made any changes or adjustments. So this idea of default options for people that don't participate, I love this idea because you're helping these employees make better choices. I like these age-based plans because once you select an age-based plan, the employee doesn't have to make any changes. It automatically happens over time. The portfolio will automatically shift, to become less risky as the client gets older.